Welcome to Just Spaces this Friday. My name is Eric Mokaya, based in Sweden, but I have a passion for Kenya. I'm the founder of Mwango Capital, where we're discussing Kenyan capital markets, and we are really privileged to have two guests here today. I think a few more will join later. It's a bit of an open spaces because we want to collect as many views as possible and perhaps compile them into one single letter and then send it to the capital markets authorities. The motivation for the spaces today is mostly this week we noticed that the CDSC introduced some levies on CDSC accounts in Kenya. And I think that caused a lot of uproar. We are up against it because it's mostly means more charges on the retail investor who's already swamped by a lot of levies and fees that we see in the markets. So today we want to break down the markets a little bit and see what are we doing right, what are we doing wrong, and what can we do to improve, and perhaps just get a better view of how our markets work. And I think one of the reasons why our markets are not working correctly, my hypothesis is mostly because a lot of people are not aware on where they can push the buttons to get the attention of the people in charge to be able to change. And I'm very glad that this week, by pushing the retail investors via Twitter and all these channels, we're able to get the CDSC to rescind a key decision that they've made about the markets. Our hope and prayer is that by discussing this, we'll be able to open up the retail investors' minds on what exactly can be done to make our markets better, because we are really passionate about these markets and we want to make sure that they succeed at the end of the day. I want to introduce our guests today. I see the NSE. Thank you so much. Really appreciate that he was able to make time for this. So without further ado, I'll start with Tim. Tim is based in Tanzania. Tim, you can maybe tell us a little bit about yourself and what you do and what brought you all the way from Australia to Tanzania.
Thank you very much. Good to be here. And congratulations to yourself and everybody for the activism that we showed this week and getting some results with the rescinding of that proposed fee. That really gives us encouragement that what we're doing can make a difference. I am, as you said, based in Dar es Salaam. I run a frontier African equity fund, Sub-Saharan Africa Frontiers. I've been doing that for just over 18 months. Prior to coming here, I spent over 25 years in Asia. I lived in South Korea, Hong Kong, the Philippines, Indonesia, working in capital markets. So my background is in sell-side equity research and then boutique investment advisory, money management. I grew up all over the world. My parents migrated to Australia when I was 10 and I completed my education in Australia, but I left Australia straight after university 26 years ago and I have not lived there since. So I have a very international background. I was born in Tanzania, although I only lived here as an infant, but I came back here because I see a lot of opportunity. There are risks and challenges, but that comes with the territory. So I'm very much happy to be involved in the development of these markets and investing capital on behalf of myself and my investors. So we have over $18 million under management at the moment, and I'm hoping to grow that further. We've come a long way since we started. Paying close attention to all these markets and happy to share my insight both to these markets and the places where I've worked before.
Great. Really eager to learn of your experiences across these markets. I know you also have very good returns this year, and I know you're very passionate about African markets and especially Tanzania, and very, very active in that space. So really glad to have you. The next person would be Kevin. Kevin, maybe you can introduce yourself to those who don't know you.
Thanks, Eric. My name is Kevin Mainangige, popularly known as Kevin Gige. I work with Jengis Investment Bank, predominantly on the equities and fixed income side. I also spice up their research desk. I've been in the market for 10 years now, having started off with the Jengis Capital. I've gone across the field to Equity Investment Bank, to NCBA, and then back home to Jengis Capital. So my interests have spurred across majorly fixed income, corporate finance, equities trading, sell-side risk. I've also been privileged to work in Lagos and Tanzania as well. So I think we'll have quite some nice conversations with Tim, and also covered stocks across the BRVM region, Morocco and Egypt, and also down south side to the Comesa region. So happy to have an engaging chat with you all.
Great. The next person will be Nderi. Nderi, welcome.
Thank you, Eric. I've been around for a while in the stock markets. I think I first put in my first trade in 2000 when I was at Suntrade Investment Bank. Now I work for ABC Capital. I've sort of shifted gears now. I'm in corporate finance and advisory. But having worked in the stock markets for a while now, both on equity and debt, I think I may have some insights I can offer to today's discussion.
All right. Thank you, Derry. Really nice to know you. I know you cause a lot of rapture on Twitter with the many tweets. And now we have the NSE CEO. Maybe you can introduce yourself and say something to the people before we get started. Jeffrey?
Thanks a lot. It's a great pleasure to be here. And thank you for inviting the NSE. I think on our part, we just want to, for those who don't know the NSE, we are the market in Kenya, the leading infrastructure in the region, and also a big player in Africa. We're happy to be part of this forum today to basically listen to your views about what we need to improve the market. I know we've done a lot. I'll be able to take and answer the questions you may have at some point. But the really is to get to hear what else you think we can do as NSE to revitalize the market. I think it's a very nice topic. The market presents a great opportunity for those who are very active on it. The performance they've had. But yes, for all this while, it's been a very heavy investment we've made in the market to just make sure that we continue to provide you with access and the ability to carry out your transactions. So mine would be to just get to the listener today and just to hear a lot of what the others have to say and maybe project as and when required. So back to you, Eric.
Great. Thank you. We have 4 speakers today, so we'll engage with them for the next 45 minutes. And if you want to join in the conversation, we have a pinned tweet. Just below the pinned tweet, you can write your comments, your questions, any things that you have. But also you can DM us directly to the Mwango Capital. After the 45-hour mark, we'll be able to allow a couple of speakers to come on board and ask a few questions, share your thoughts. As we're taking this very seriously, we are taking notes and we'll compile them and try to send them also to the NSE. And really glad that the NSE is actually present to hear some of the comments. The focus is just simply what's the history of our markets a little bit, where are we and where do we want to be and what can we do to revitalize the market, because we're really passionate about all this. So that's a simple guideline. We aim to be as civil as possible. But secondly, also we want to raise the pertinent issues that we want to really address at the end of the day as participants in the markets. But then finally, also we would want to maybe ask if you want to speak, we would give priority especially to people who have real names on their Twitter handles. Just make sure that your handle has an actual name, and so that we can be able to know who you are and not just allow anyone to speak tonight. So hopefully we'll have a really, really good time. So I'll get it started with Kevin. Maybe Kevin, you can give us a little bit of perspective on our capital markets, especially in Kenya. Who are the key players in these markets and what are the key organizations that have a role to play in the markets? And maybe after that, Nderi and Geoffrey can add, and then I will go to Tim to give us Tanzania's perspective. So Kevin, the mic is all yours.
All right, thanks, Eric. So maybe just to start it plain simple, assuming no one has ever been to the stock market here, is we have the key stakeholders in Kenya, of course, the Nairobi Securities Exchange, and I'm glad Geoffrey is here, very good friend of ours. So the Nairobi Securities Exchange has brokers underneath licensed by them, and the Capital Markets Authority, who is also an SRO. So the brokers are all listed on the NSE website, the licensed brokers, roughly 18 to 20 or so. Not all of them are actively trading. You have your broker or your investment bank that puts in trades on your behalf with a system that is hosted by now Nairobi Securities Exchange. You have your CDSC that has been on the news lately, especially this week with the introductory of new levy, the central depository. Those are the custodians, quote unquote, of shares. Like way before we came to the digital era, we had the share certificates and all that stuff. So they've been there for a while. I work with Jengis Capital. So in our space and how we've seen the markets here, especially if you go to the NSE website, if you've been following keenly the markets year to date, you'll notice that we've been on the red. I think just today we're looking at the NSE 20 share index, and it's down 20 points, I think, to 1680. The all share down to 132. Total turnover, shares traded, market capitalization, everything has been shrinking this week. And Eric, just to confirm, do you want me to just give a structure or just get down to the markets already?
We can come to the markets. Just want to get an overall view of who the key players are, and definitely we'll come to the performance of the markets. So maybe, Nderi, can you add a little bit on what Kevin has said about the capital markets structure and who are the key players? Anything that Kevin may have missed out on or you want to add on?
No, maybe how I do it, you've given you sort of the architecture, the key organizations. Let me see if I can cover it from the angle of the architecture. First of all, the architecture, the way it is, because of of the role of the capital markets in the economy. And the primary reason the capital markets exist is because entrepreneurs want funding and investors want to put their money somewhere to earn a return. So the markets are designed in a way that allows that to happen, and hopefully the most efficient way possible, because remember, investors need to be protected and entrepreneurs need low-cost funding. So with that in mind, you have the NSE that sits in the middle, and you've got sort of stock brokers to help investors buy and sell shares. And then on the other side, we've got the corporate finance advisors who help entrepreneurs raise funding and structure the transactions in a way that protects investors as well. The stockbrokers, as Kevin has mentioned, and then you've got a couple of corporate finance advisors who it's their job to onboard businesses onto the stock market. And then regulating all this is the CMA. I think I'd want to stop there. See if maybe Jeff can add something.
Over to you, Jeff. Maybe you can tell us a little bit what's the distinction between the CMA, NSE, and CDSC in terms of the role they play in the markets.
Okay, thank you. So the CMA is our primary regulator. They're the ones who license all the players in the ecosystem. So we as the NFC also licensed by the CMA. The CDSC is also licensed by the CMA. So they have the regulatory powers to oversight the market, ensure that fair play market conduct is in order. They then also the final approval of issuance. They also approve any new products that we want to introduce in the market. So that's their role. So as their role is to really oversight the markets for the regulation. That's by the CMA Act. The CDSC is the depository and settlement company. Now their role is to keep custody of all securities trading in the market, and then they also facilitate the settlement of transactions. So any trades taking place are settled at this by CDSC. That's ideally the role they play. And they also do what they call other services, other support services like pledging. If you want to get a loan, you have to pledge your shares through the CDSC to the lender. If you want to transfer shares privately, again, the CDSC, they're able to facilitate that as well. And so they have that role. They also are now offering security lending and borrowing. So if you want to borrow stocks, they have a facility able to offer where you can actually borrow stocks, trade, and collateralize it after some time, come back. And then we have the brokers who are members of the exchange. They get a membership trading license that entitles them to trade. So you cannot trade directly to the market as an investor. You have to go through a broker. They've actually improved that process tremendously. So it's almost straight through, but through the broking house because of technology. That's the role they play. In the ecosystem, we also have the fund managers who are the ones who manage pension funds. They are regulated by the RBA for pension fund management and CMA for other funds. So they take 2 licenses. We have custodians who keep now assets for the fund managers in the process. And we also have investment banks who structure issuances, for instance, an IPO, a rights issue, a corporate bond. They're the ones who prepare the application documents and submit in the CMA and ourselves for approval. So, and we have other players like nominated advisors. And then out of that universe, of course, we have other advisors like lawyers, auditors, accountants. So it's a very robust ecosystem, has very good capacity, as the team may have cited here. And we are in the process of improving that even further. Now, what's coming out to just enhance interest from the supply side is we are revising the public offer listing and disclosure regulations. They're now out for public exposure. So we're looking at those regulations and seeing what are the incentives that we need to improve, what are the obstacles we need to remedy. There's that discussion going on now. And so we call it on investors to have a first sight of those regulations because they'll help us improve the supply side, which has been one of the largest limitations we've had in this market. So that ideally is structure the markets. We then have investors who comprise of international, local, and regional. The current distribution is largely skewed to the international market. We then have local, institutional, and then retail. Now, the retail is where we have a lot of work to do to bring back to the market. So that's how the market is structured, and we'll be seeing how we can improve it even more.
So a quick question. I think something that has come up, especially during this week with the CDSC and NSE, is there a point in time where the two are one, and why are they separated in this market specifically? And is that normal in other markets?
Well, after 2000, CDSC and NSE were one institution. Actually, it was known as the settlements division within the exchange, within the Nairobi Stock Exchange then. But in order to provide independence and also at that time I think the discussion then were separating these two entities would de-risk the business and also would strengthen the framework of the market. And the CDSC Act came into place and created the CDSC. And at that time, we also had regional aspirations. So we said when we were creating the CDSC, we wanted to have like a regional depository, and the shares, when it was incorporated, the shares were distributed between the NSE. There was a consortium of investment banks, of companies that also were interested, and also we had some regional exchanges who were invited to participate. So that is how the structure was. And so in the current structure, we have the NSE, we have a fund called Challenge Fund, which is a mutual entity of companies. And then we have the United Stock Exchange, who have a stake in it, and also the CMA have a stake in it. So the intent then was to create an independent exchange that if we remained at a joint entity, then it would have limited the role for opening it up to invite other players or other exchanges to come and work with the CDSC then. That was the aspiration then. But what has happened over time, every country has decided to set up their own depository. So that regional aspiration did not come to fruition. But that was really the purpose then. Thank you.
Good question. And would be, is it time to merge them?
I would not be able to sort of provide an answer to that because there's a lot of considerations that are taken into account. I think what is more important is to set up a strong environment that allows for trading to happen highly efficiently, and which we've done through having IT infrastructure that speak very well to each other. And so it's not, at this point, it's not very easy to say what would be the desirable. Because also don't forget, we have another depository, which is the Central Bank of Kenya. That's a separate depository for bonds, so government bonds. So a number of other considerations that are taken into account that probably at this point I can't diverge.
All right, thank you. Team, what's the experience in Tanzania as regards markets, generally, the market structure and the key players there? Is that any different from what you've heard in Kenya?
It's not all that different, to be honest. The DSE obviously is a lot younger. Tanzania didn't embark on their privatization and capital market policies until the 1990s. But the DSE was established in 1996 and got underway. It's much smaller. I think there are in the low 20s listed companies. There are cross listings. Some Kenyan companies you're also able to trade here. But the regulatory structure and the various different players are very similar. There's the exchange, obviously, with members, brokers, and investment advisors, custodians, nominated advisors, bond traders, fund managers, all of whom are regulated by the CMSA. And then, much as you have just been discussing, there is also a CSD, Central Securities Depository here. It is still a fully owned subsidiary of the Dar es Salaam Stock Exchange. It sits within that, but operates independently as a unit of the DSE, and the lay of the land is really quite similar. So I'm not sure where they lifted their various different policies from, but logically, there was probably a lot of regional cooperation on it. And exchange in Nairobi has been operating for a lot longer, and I'm sure that they borrowed some of the systems and structures that were there. There has been talk over the years of exchanges being integrated and operating, more on a regional basis. But every time that there's an announcement that things are moving in that direction, it seems that it never really quite happened. I think probably an opportunity for consolidation over the years, but obviously there are different interests at play and the countries are very different. I mean, I always find it quite amazing when I make a trip to Kenya from my base here in Dar es Salaam. So it's only an hour and 5 minutes or something to fly, and it's like another world in many respects. Hopefully over time we can regionally integrate and create some synergies. But at the moment, it seems that as though everyone is operating with very similar structures in parallel. That might take a while.
All right. And if you compare that to your home country, as you say, Australia, how's the market structure there? And what can we learn from what you've seen in East Africa generally?
Yeah, I have a fairly international background, and I was based in Asia for many years, servicing clients who are investing in Asia. But personally, I've also invested in Australia since 1998. Australia is a very advanced market. I think it's the fourth largest pension market in the world, and it punches well above its weight, given that it only has a population of somewhere in the high 20 millions. There's a very successful retirement savings legislation there that was brought in back in the early 1990s, I believe it was, called superannuation, where basically everyone who is in paid employment sets money aside for their retirement from their own salary and also from their employer's contribution. And it's significant. I think it's 8% that you have to put in, and the employer even puts in even more. So it's a very advanced market, and it's obviously very efficient in terms of the major differences that I see between the Australian market and here in East Africa. I was commenting earlier in the week when these proposed CSDR levies came out. In Australia, it's actually the listed companies who bear the burden of these costs. So they have these things called share registries. But there's no one body that keeps track of who owns which shares. There's two different ways that it's done. Either you are in the what's called the CHESS system. They have a similar thing in the UK called, what's it called? CREST, I think it is. So it's very similar to the CSD systems here in East Africa, and it's maintained by the stock exchange and the market participants. And then as a client of a broker, you can sign on to be a member of that system. But if you don't want to be part of that system, you can also be what's called issuer sponsored, which means that there's a share registry that's paid for and kept by the listed company itself. And then when you come to sell through a broker, you have to give them what's called a security holder reference number, an SRN, rather than a holder identification in CHESS. There's competition, if you like, between the various ways of holding securities. And it's at no cost to the investor. Those costs are absorbed by the listed companies themselves, or I think the brokers and then the stock exchange, absorb those costs. It's all about CHESS, which is, it's actually a world leading system. And they're actually in the process of moving it all over onto blockchain, as I would understand it in Australia. It's sort of at the vanguard. It's a big competitive market. Fees are low. Lots of people are interested in the stock market. Nearly everybody who's in paid employment has an interest in the stock market through their retirement plans. So it's a long way further along the development curve, if you like.
All right. Thank you. Perhaps what you're going to do now is to reflect a little bit on what's going right and what we can improve on, especially in our capital markets in Nairobi. So I'd want to perhaps start with Kevin. Kevin, maybe you can give us a perspective on how our markets are doing. How many listed players and entities do we have in the markets, and how's it been over the years? And have we had some boom periods, stuff like that? So maybe you can give us that, and Darian, Geoffrey can add also.
We were doing fine prior to, of course, the pandemic and everything else, the exogenous factors that have followed ever since. So we have roughly, if you look at the NSE website, they say we have roughly 65 counters. I think that has come down maybe to 62. If I'm not mistaken, listed equity counters. As I mentioned earlier, we have roughly 18, maybe to 20. Not everyone is active brokers in there. It's been also a bit tough in terms of just bringing in companies to list on the Nairobi Securities Exchange. I think as of 2019, if I could go that far, our market capitalization was around 22.3 billion USD. And I think if you go further back, between 2014 and 2019, we only saw 2 IPOs. And that one was the Nairobi Securities Exchange itself, and 2 was the Stanley Bahari, right, which was valued, I think, roughly at around 42 million USD. We haven't seen, I think as per the CMA master plan, the idea was to bring in around 4 IPOs. We haven't seen that, and Jeff will maybe speak or attest to that. And I think since between 2014 and now, I think the only other thing we could have seen, in addition to the 2 I've mentioned, would have been the Homeboys one as well. The markets have really shrunk, as I mentioned earlier, and the indices, we are down to 130 on the all share, we are down to 1680s on the NSE 20. Those are our 2 prime indices in terms of market capitalization, in terms of shares traded, volume, turnover. All the indicators are down. I was just looking at things this evening, and we saw it down to 27 80s level. It is on Tuesday, I was in the office and it was at 30. So you can tell the speed at which Safaricom is coming down. And I was just telling someone, Safaricom is, I think, almost 56% of our market capitalization by itself. And as such, if it goes down, it drags everything else down with it. We've just seen today the books closure of Equity Bank. So you can anticipate there will be some further downswings on Monday when we come post-div. It's been a tough for the market in terms also on the debt side. Of course, the debt side has predominantly been government debt, where there's been a slowdown as well, same as with the IPOs. On the IPOs, there's been a slowdown on the corporate debt side as well. There have been some changes though, and I think some of the things, and to the discussion today, was what are some of the things we can do to just spice things up in the Nairobi Securities Exchange with all stakeholders in mind. I think if you look at the Retirement Benefits Authority, for instance, they have a maximum allocation of around, I think it's 10% that can go to private equity. But if you look at it as of 2018, I think only 0.04% was going on to that sector. So that tells you that there's potential and things can be done. It's just that things are not being done. Come November last year, I think we saw one of the newest inventions by the NSE, and that was days trading. We now have CDSC, I think, piloting the SLB, that's securities lending and buying. Some brokers have already been signed up as agents by the CDSC to partake that. We're here to see how that goes, and maybe Jeff will also speak as to, I think, as he was saying a while back, I think it was a month or two ago, that day trading was contributing around 5% of the average turnover. Is here, I'll speak to that. So there's a lot that simply can't be done. We've seen, of course, the derivative side. I think on average, we talk around 300, 400,000 Kenyan shillings weekly volume or daily volume. It's not much. Of course, we only have the indices and single stock futures on Safaricom, Equity, KCB, ABL, BAT, ABSA, NCBA Corp, etc. So not everything, again, is under the futures market. I have no idea why we haven't really started. Maybe one of the ideas is also to start the options just as a hedge against the spot. I don't know if such talks exist and where they might have reached. Again, maybe Jeff could talk about that. He mentioned something that I've always been asked by clients in terms of, can we have direct market access? Maybe Jeff will also speak on that in terms of where are we with DMA. But as we stand now, a client, even if they're placing an order by themselves, it needs to pass through the broker's infrastructure to go to the exchange. So there's still that you cannot bypass your broker to go directly to the exchange. You still don't have that DMA, the direct market access. I don't know talks on that, how far we've got, but I think it's about time we disrupt ourselves, even as a broker. And I'm speaking coming from a brokerage or investment house and background. So it's been a tough time. Of course, came the pandemic. Post that, of course, we had the Russia invasion of Ukraine that really hurt our markets. We saw some capital flights. We are now talking 3 months shy to an election. We've seen foreign participation come down from highs of 86% to now we're talking about 53% as of April. It's been a tough time. Of course, on the MSCI index, someone was asking me why then Safaricom, despite solid numbers and solid grounding around around Kenya and East Africa in terms of the super app, why is it still losing as much? And I was telling them from a client perspective seated in Miami and looking at the MSCI Frontier 100, specifically on the telco, the one stock that just blinks up on your screen would be Safaricom. And then, of course, with an election that is hotly contested, there's no clear favorites. So the change in policy or shift in policy could go either direction. That uncertainty is something that investors really don't like. We could continue to see this shrink for the next odd 3 months, God willing. And my challenge to Jeff is maybe just talk to us about, of course, day trading and how much it has contributed to that. Because the IPO drought, with only, I think, 4 since 2014 that we've seen, DMA in terms of direct market access, in terms of reducing fees. We've discussed a couple of times about training and about how to bring in. If I give an example of a market like Pakistan, Pakistan has 92%, last I checked as of 2019, it had 92% local participation in their markets. So whenever they have these exogenous facts and there's a capital flight from their markets, they're not really hurt as what we'd experience here in Kenya. So here we have 53% foreign driven. Then you have a bulk of maybe 40%, which is institutional, who mostly copy and paste what their foreign peers are doing. Then you have an odd between 4 and 8% that are local. We saw the numbers from CDSC there, 1.6 million total accounts. Out of that, 1.175 million are dormant, 475,000 that are not dormant but have not yet traded in Q1. and only around 57,000 accounts that actually actively traded in Q1. I mean, that's a paltry 3.4% of the total 1.675 million accounts. So these numbers are worrying. I was surprised that CDSC would then go to an extent of imposing a levy instead of just looking for other ways to just spice up and bring up these accounts to life. Again, Dundo, maybe Mr. Dundo can speak, them being a huge shareholder of CDSC, as to what informed maybe this thinking. Eric?
Many points that you've raised.
Let me try and speak to what I can remember. Then any gaps, you tell me. Let me put it in context. It has not been all bad. Let me start by saying that. Let me give you some numbers, and I think Eric must be having some very serious data sheets. Kevin must be having some very serious data. Last year, we had the highest market cap in the equity markets, $2.93 billion, equivalent about 2.93 trillion shillings. So let's just use the shilling was at 100 at that time. That's the highest market cap in the history of the NSE. That's the valuation. That's the market capitalization that we attained last year. I think it was somewhere around September. So you can see how that the markets were very robust then. I mean, you're talking about Safaricom. Safaricom was hitting 50. If you go to the bond markets market cap was 3.32 trillion shillings. Again, very, very high channel. The highest again. Last year we had 956 billion turnover in the bond market. Again, the highest in its history. So the markets are going through a normal cyclic experience. There's nothing fundamentally wrong with this market at all. At all. I mean, look at markets world over. Last 2 weeks ago, we had the market's downturn in the US. Inflation is rising. Our market is a member of the MSCI Frontier Market Index. We're not insulated from that. That is an effect that affects all markets who are accessing global capital. We are going through a normal cyclic period. Albeit the fact that we have an election, which somebody could say has sort of led a bit more uncertainty to the market. But is it the first time we're doing this? No. Every 5 years we have an election and the markets go through these cycles. So I'll disagree with Kevin that the market has a fundamental issue. There is no fundamental issue. Nairobi Securities Exchange today is the second market in Africa with the most diverse product offering, 7 different asset classes, and all contributing a revenue. You would call it small, but it's a revenue stream. Many of the products are not idle. ETFs. We have a gold ETF in our markets. Again, since COVID, the issuance price was 1,250. Now it's in high 2,000s. Trading. Real estate investment trust. It's trading. We have done another platform for the USP, again, for the real estate investment trust. Bond market last year, we issued 3 new bonds, corporate bonds. We raised a total of 18 billion shillings in this market. And the subscriptions were in excess of 50 billion. So what are we saying that the market is not functional? It's functional. It's attractive. It's raising money. This year alone, I've done another bond, Kenyan Mortgage Refinance Company, 1.4 billion. Total capital raise, 8 billion. So the market is functioning. And we have got a pipeline, a very strong one. The year has just started. We just cleared Q1, and we had an issuance. We also brought in Bank of Kigali 3 years ago, a cross-listing that issued shares into the market afresh. So it was like technically an IPO. We have rights issues that have come to the market. Crown Badger raised 781 million. So where's Kevin getting his data from? It's totally not correct. Let's look at the facts. So the market is functional. We are able to trade our products. We're getting clients accessing the products. And that's good. I mean, you can cite Pakistan, 92% retail. Is that the market we want? No. We want a equitable structure. We want a market that has a balance of local and institutional. Institutional drive valuation, and institutional also drive liquidity. So if you leave your market purely retail, you'll have a very thin market. A very, very thin market. So we're happy with the structure. We've got a lot of work to do to improve retail so that the retail can become a larger portion of the local pool. But you can't say that you don't want this. Those markets are struggling with retail. I was in Shenzhen, 300 million customers. They've been asking me, how are you doing institutional? We want to see more institutional flow. So we've got to strike a balance. That's what's positioned us to be an attractive market in the world. I mean, and to be members of MSCI, to attract approach a market funding, you must have certain level of liquidity. Our turnover ratio last year was 5%. We are targeting with day trading to push it to 7.5%. Total turnover day trading last year was 3% of turnover in just 2 months. So I'm putting the point that the markets are functional, our asset classes are performing. We albeit a bit low because of the uncertainties of global inflation and the elections and all this. But these markets tend to recover post-elections. And I'd want somebody to hold me, and because I'm very positive, the markets are going to recover post-election. Because fundamentally, our markets are attractive. Our companies are functioning. Look at the yields. Look at the percentage growth we saw across all the companies this last year's performance. They've been extremely attractive. We have a world-class market in Africa. We are really highly recognized as a very innovative exchange. Given the things we're doing, we have so many innovative products we're doing. And even as we are members of the World Federation of Exchanges. Now, let me tell you, Eric, we also had the first green bond from the private sector in Africa. To speak about sustainable financing, we had a trailblazers when it comes to green bonds. So we are ticking all the boxes. We are ticking all the boxes. The IPO drought, I know, is a perennial issue, but don't forget that we are still listing other asset classes. So we are there. We're working on the IPOs. We've never stopped. Our efforts are very visible. We're doing engagements with various issuers, and we've even built an Ibuka platform to accelerate SME entry into the market. So all these cannot be discounted and say that that's what IPO is not the only thing we do. We do a lot more. We are doing a lot more. Look at the performance of the exchange last year. We were profitable, extremely profitable. So I'm putting the point, Eric, that nothing is fundamental wrong with this market. It's a low period because of what's happening, a lot of factors, but the markets are fundamentally strong. Now, speaking on the fees, I know the whole debate about fees, we must agree, and that's the beauty about Kenya, is that there's discourse in any issue. I mean, right now we're having very good discourse about politics and very, very freely to do that. Well, one of the things that we're saying as a market, the CDSC had an interest to see how they can continue financing their business, offer possibly more in-depth consultation was necessary at that time, and that's why they pulled it back. But it's because of the discourse we have. We listen to our customers. We don't ignore and just enforce things there. So I think it was as good we have in the country, and it allows us to change decision. And really, it's only a wise man who doesn't change his decision. So we should not also be too hard for that direction. So what I'm trying to say, Eric, is that, and maybe if I forgot about something, you could raise it, is that our markets are strong, performing well. The data is there to prove that issuances have happened in certain asset classes, and we are open for business. Really, we're seeing all these investors who are talking to us and they came to come to the market. So I'll probably pause there, but just in case I left anything, you could ask. Thank you.
All right. So a couple of questions. So number one was about the issue of comparing a lot to the African exchanges. Some of the exchanges across Africa, when I look at some of the data, there have been more listings in some of these other markets. So I think when industry participants are worried about the pipeline, so we'd want to see like what exactly is in this pipeline and what has taken so long in terms of some of these companies coming to the markets at the end of the day. And secondly, one of the things that also investors have been worried about this week was, while in other markets we see like a decline in the costs, especially for trade, like the CDSC this week was looking to increase those kind of fees at the end of the day. And what we've seen, at least in the markets, and I'll share this chart with you, is that where you decrease fees, what you see is a spike in volume that actually more than compensates for the decline in terms of cost at the end of the day. So I wanted to ask, what exactly is the NSE and the capital market participants doing in that regard in terms of reducing that cost? And especially when you have day trading, where trading 2 ways in a single day can actually eat up into the margins that you have in a declining market. So I think that's a question that I wanted to ask. And Kevin seems to have a point that you wanted to ask.
Yes, and I think my good friend Mr. Dundo probably misquoted me. I didn't say there's something fundamentally wrong with our markets. If there was something fundamentally wrong with our markets, I wouldn't be in the markets right now. My concern, and of course, I agree to his point that some of these shocks, and that's why I mentioned earlier, some of these shocks that we're experiencing have been exogenous, supply chains, foreign invasions in the Ukraine. Of course, we have now an election. It's cyclical every 5 years. There's nothing we can do about it. We've seen what markets has done. My point is not to attack My point is, what can we do wholesomely, collectively, as the stakeholders in this market? I've had him talk about fees, and I think your question again right now will be about the fees, of course, especially on day trading. We've looked at data. Jeff holds this data and maybe is in a better position to tell us more about it in terms of over the last, say, 3 to 5 year period, the volatility that we've witnessed on, if you look at a daily average, has it been sufficient with the fees that we have right now, despite having a 5% discount? Have those fees, if you're going to do a full leg, that's a buy and sell, will those fees, has the volatility rather been sufficient, inclusive of the fees, for any investor to make anything significant?
And the question of fees, I have a chart here that shows, like, at least in the US markets, when you reduce fees, there is a spike in volume that is actually more than compensates for the reduction in fees. So I understand also that you reduced the fees one way in the leg in terms of helping out the day trading. How about also reducing it both ways and maybe testing it for a product like day trading and seeing if there is actually a spike in volume, and then maybe we can replicate it across the market? Because costs as they are currently, I listed them a while back. So when you're making one leg of a transaction, you have the brokerage commissions, you have the CDSC transaction levy, you have the CMA transaction levy, you have the NSE transaction levy, you have the CMA guarantee fund fee, you have the CDSC guarantee fund fee, and you have the KRA corporate stamp duty. So for a trade that we made of around 1,440, you already have like some fees added on top of that to make your trade a bit more expensive. To do this two-way in a market where the stocks are not rising very significantly, then you end up even more in the red as a trader. So of course, the NSE and the CMA and the CDSC are making money from all these trades. Is there a way in which you can cut on some of these costs? People are a bit more motivated to make more trades at the end of the day. Is it something that you want to try, or at least willing to try? And I think the aim of this space is mostly to give ideas that possibly we could try out and then see if this works in our markets and how we can be able like to spark activity. So Kevin talked about 4% of the trades being from retail. So I think that's really small, and we need to encourage a bit more of that retail trading. And that comes also from at least giving some incentives in that regard. So perhaps for the retail investor, you could try and reduce that. So is it something that you would likely consider?
We're happy to look at the data, to be honest. This is a new product, and if there's anything that we're looking for, is volume. As I told you earlier, NSC, we made a move to reduce that by 5%, and we're really keen on looking at that data. If it helps us to spike the market, we'll be happy to look at it, to be honest. We want to make day trading very, very successful. And so listening to what the market is asking us as well, we'll be keen to look at that. Yeah.
Right. Kevin, you have something?
Still on fees, maybe Mr. Jeff, the one thing that has been on investors' mind this week and has really boggled us all has been the CDSC levy that was being introduced for accounts. Now, NSE has a seat on the CDSC board. I think, Mr. Odundo, you do sit on the CDSC board. So my question was, with the introduction of this fee, and we've had Mr. Mubesa, the chief executive, speak about some fees being legislative and some non-legislative, and that this fee was one of the fees that was non-legislative, and as such, there was no need for public participation. So my question is mainly to understand that if it was this fee a board approval, or is it a one-man show with CDSC? Because honestly, yes, CMA and NSE are going the right way by giving incentives, albeit not being much of 5%. But then how do we go counterintuitive again, counteractively with CDSC increasing these fees for an already shrinking population of retail investors? I'd really want to understand the thinking behind that fee.
Well, I think it's not fair for Eric to expect me to disclose board discussions in a forum like this. So unfortunately, Kevin, I won't be able to answer that question.
All right. But then in general, about the perspectives of reduction in fees, perhaps, as you said, it's something that you're willing to try, but could we also like get a time frame within which maybe you can try out something like this? The market can also see like there's some actions being done in terms of trying to spur market activity.
Eric, this is not a new discussion. It's a matter that's deliberated at every board meeting, and you should be seeing some further developments in a very short while.
All right. I think one of the questions I see here is about that if the commissions are about 0.36% per side, that's 0.70% on both sides of trade. So I think it's a bit too high in that regard. So we need to encourage people to trade a bit more. I see Kevin has more, but I want to move to Nderi a little bit. Anything to add?
One good friend of mine, and we've had these discussions with him a couple of times. Maybe, Mr. Jeff, one more thing that I think we had on our prior discussion and has not actually been actioned to date has been just how to make the NSE and its services more ergonometric to the investor in terms of, one, there's the NSE website that has really grown and has become somewhat ergonometric to the investor, but we have seen mismatch in terms of sometimes companies list their results, or we have this announcement, but on the NSE's website, the listed companies on the announcements page, you'll find that it's blank. That's number one. We've also discussed issues surrounding an investor calendar. I don't know what progress we have with that. I remember we discussed it with you, I think, sometime last year or early this year, either in November or January to February there. So that's another thing that investors maybe would want to hear about, just to compare ourselves to our peers. And finally, has been on NSE trainings. We've seen a couple of times when NSES is reaching out to train people just to try and bring more and more people to the capital markets. But I don't understand the reasoning behind charging them upfront, as opposed maybe to just bringing in the masses and benefiting on the long term, maybe just playing a long-term ball. And you're the expert in this, maybe you can enlighten us.
And perhaps in that regard, then, when are we seeing some free seminars, perhaps from the NSE or for the retail investor? And if it's about the earnings calendar, I think I remember asking this question again 6 months ago. I think a very good precedent that you can easily set. We at Mwango Capital do this a lot. So we compile data, mostly actually from the NSE itself, compile on AGM, and compile on when companies have reported, specifically when they send out to you. We appreciate that the NSE actually sends out most of the emails, especially from companies when they're reporting. But it will be really, really easy for the NSE to actually ask companies, hey, when do you expect to report, so that we can put it on our calendar? And yes, it's okay to change the dates, but at least we have a specific date when we expect from you the results. I think it's a simple thing, but it really helps so that investors can track some of these companies' earnings very closely and know, like, at least in next week we expect Safaricom. And Safaricom, I think, and I think Centum and a few others have been very, very good at this. You can see during their reports for the year 2021, they gave us a calendar for the year. They told us on May 26th, you can expect our earnings for Q1. That kind of expectation is very easy to be driven by the NSC specifically. And perhaps it could start with you guys. I'm sure that board meetings are prepared way in advance. You sit at the CMA, CDSC, and all these boards. I'm sure that like 2 months in advance there will be a meeting. So I think it is also possible for investors to also get that feeling of, okay, in 2 months, we expect maybe Bamburi or some of these companies to report. So is this something that we'd also expect from the NSE to be driving actively on behalf of the investors?
I think it's an improvement we'll do on this calendar. I think that is a good ask, and we can co-opt that. That's a very, very good ask. We currently provide the earnings, the schedule of announced earnings that appears on a daily price list, I think, on the website. But I think the forward earnings schedule is something we'll be able to consider. Very, very, very good feedback on that. On the issue of on the website and having the results posted, we do this real time, but allow me to check where the gaps are so that we'll be able to improve on that as well. We did a total revamp of our website, and thanks, Kevin, you've noted that it's now more interactive, and that was the plan. And maybe just an improvement, and my colleagues are on the line who will be able to take that up. On trainings, Kevin, yes, we do have trainings. We have scheduled classes. We have various courses we offer the Digital Academy. We also have open trainings where we do invite investors to come in and learn on some products. We did a lot of webinars during COVID, and we've just gone back to full-time training, but I think we can do more, especially targeted towards retail. So that I also admit we're going to improve on it and see if we can be able to provide more financial education. We don't have a lot of content as far as the basics of the market on the website, and we can be able to increase that. So that's a good feedback, and we'll see how we can partner.
On the trading aspect, I wanted to double click on that a little. It's charged, and some of the fees are a bit steep for the retail investor. It actually feels more costlier than paying the account maintenance fee for the investor every year. Is there a possibility that some of these trainings can be made for free for the investors, especially for the beginner level courses?
Let me take that as feedback. As you know, this discussion today is about how can we improve. So these are points I'm taking down.
All right, Nderi, over to you.
Thanks, Eric. Sometimes I feel we have laid too much on the door, Jeff, especially some issues. I wonder what you can do about them because, for example, I think the biggest proportion is the broker. I don't know how much power Jeff has to tell his brokers to lower fees. But anyway, I'm sure that's a conversation that can be had. Let me try to speak on two levels. Number one, as an advisor to issuers, And I think my experience with both NSE and CMA, Jeff and team, and Shami and team has been generally positive. We have gotten very good support for the transactions that we've brought and they've been successful. And I think both as a nomad and as a TA, we don't have much to complain. We are also very happy with the efforts around the issuers regulations that have been published for discussions, the drafts. There's a lot of positive stuff in there. Speaking for entrepreneurs, the people who've had a voice today is just retail investors. But speaking on behalf of entrepreneurs, I can see a quite bright future because now I think SMEs will be able to access the market, both from debt and equity perspectives. I know there's been discussions around quality of issuers, but for me, I look at it as a party. The more the merrier. Let the investors choose what they like and what they don't like, and every Jane find his John in the marketplace. Now, but I do have a worry with regards to the market for two reasons, and these are macroeconomic issues. Number one, I also track the amount of savings in the economy. And I think we are going in for hard times. You can tell from the distress we are all seeing, or I think I am seeing from the government side. Levels of savings as well is quite low. In fact, our levels of savings don't even cover rate of depreciation, which means we will need a lot of foreigners coming in to plug in the holes. Otherwise, we will see a drop in productivity because we will not be able to sustain the quality of our assets, so to speak. So I think there's a concern here that needs to be addressed. Jeff, you do have a role in speaking for investors, portfolio FDI, which can help support the markets and the economy. But in a scenario where we are seeing rising interest rates, I don't know how much we can do about that. Those two issues, the macroeconomics and the low savings rates, for me, I think should bear some of the blame for the low asset prices that we're seeing in the market. Thanks.
Tim, do you have pointers to add here now from your perspective?
Well, I mean, I was alluding to the fact earlier that if you think it's bad in Kenya, it's actually even worse here in terms of the fees and charges that small investors face, unfortunately. One of the differences is that here they also charge 18% value-added tax on the brokerage. So I just looked at my own records and I sold a small parcel of shares during the week on my personal account, about $1,500 worth, a small sort of trade that an individual retail investor might be making here. And I paid 2.38%, one, which I think even with all of the various add-on charges that you have in Kenya, brokerage is the least of your concerns. I think the brokerage is probably lower than all of the various other charges that get added, but it's still somewhat better than here. So I think there's a long way to go before we get to the point where retail investors can trade without worrying about that eating into their profits. But it is what it is. The other thing that I just wanted to raise briefly as well, which is related, although not directly on point, is that in a lot of other markets, you're also able to transfer the ownership of listed company securities off market. In other words, you fill out a form, you nominate the person that you want to transfer them to, you write their name, you sign it, you stamp it, whatever it is that's required, and then the shares will transfer from your CDS account or whatever the equivalent is in another country to theirs. And there's no charge. There might be a stamp duty in certain countries, but in most countries, there's no charge at all. In East Africa, and I believe elsewhere in Africa too, that's totally impossible. The exchanges all have a monopoly on the transfer of shares that are listed. So every listed company transaction that involves the transfer of shares has to go through the exchange. Even big block trades, like there were two famous examples here in Tanzania in recent years where Vodacom in South Africa bought back a huge chunk of Vodacom Tanzania from one of the fellows that owned it, and it had to go through the exchange. The other one was transfer of ownership of a 34% stake in NMB Bank that was held formerly by Rabobank out of the Netherlands. And they were transferring it to a foundation in which they are a participant. And then the Dutch and Norwegian government aid agencies are participants. The Arise Foundation, which also has a stake in Equity Bank in Kenya, I'm sure you're all familiar with. So these kinds of things are further inefficiencies that could be improved on. They're great for the exchanges, and good luck to the exchanges if they can get that kind of cushy deal. And I have been a shareholder in the Dar es Salaam Stock Exchange as well, and I have thought about being a shareholder in the Nairobi Exchange. But they're monopoly businesses, and they have very cushy circumstances. And I think the answer is competition at the end of the day. If you want prices to come down, you need competition and force them to provide a better service than the competition. And if they do, then customers will stick with them. That would be my answer to the issue if I were a regulator or a politician, but I'm not. So there you go.
On this point regarding transfer of ownership, in Kenya, we do have that ability for you to do private transfers as long as there's no change in beneficial ownership. So that's what the private transfers are allowed.
Yeah, but the whole point, sir, is the transfer between beneficial owners. There's also an exception here in Tanzania, which is in the event of an estate. So you can transfer to your heirs, but that's it. In every other country in the world outside of Africa, if I want to sell shares to my brother-in-law, that's fine. I do it in an off-market transfer and there's no fees involved. So that was the point I was making.
I get it. Okay, I get it. Thank you.
All right. We have two speakers here, Ruben and George, and perhaps you have some questions or comments on the topic. I would start with George.
Cool. Mine is very simple. As you know, I do a lot of retail bond trading. It's actually really hard. I don't know if anyone here has ever done a retail bond trade. It's actually hard. You take probably close to a week, 1.5 weeks to actualize the trade till settlement. So is there a way we can make it a bit easier? I know one of the biggest challenges is on the CBK side, because they are the custodian. So it's hard because they have to give you an order number and all that. But is there a way the NSE can come in and maybe rope in CBK and make it a bit easier? Because doing a retail bond trade is really hard.
Yes. Kevin, you speak after Ruben.
Thanks, Eric. I hope I'm audible enough. Jeff, you mentioned around the turnover of equities on the NSE as a percentage of market cap being 5%. And you rightly mentioned before, we are not trying to be, like Bangladesh, and we needed like a fair mix of one turnover, but also like retail versus institutional investors. I was just interested in what markets in Africa you most likely want to benchmark against as far as the equities turnover's percentage of market capitalization looks like. And I think over and above that ratio, I think it's also important to think about what our market capitalization on the NSE is as a percentage of GDP, just to have, a fuller picture of what the stock market represents in terms of the overall economy. Because if I look at 2021 numbers, so Kenya, our turnover is 5% of market cap, and our market cap is around 25% of GDP. But also we have markets in Africa, like where Morocco, for example, where the market cap is 63% of GDP, turnover is still high at 7.5. South Africa are doing 4x, which is like 427% of GDP, doing equity turnover of 26%. And many other examples of other markets which are performing us in terms of market cap and also turnover. So I would like to hear your perspective on that, so that at least we know, even from your perspective, what markets you prefer to benchmark with, if not Bangladesh. Thanks.
Thank you. I like those last two questions. Very good questions. Yes, we normally track a ratio of where we want to be as a percentage of GDP. As you know, we really have to, we mirror most of the company, most of the sectors in the economy. Our plan, under the master plan, I think we were targeting to be 50% of GDP by 2023. And that was premised on the fact that we'll be able to grow the listings. But I think as we are moving along, our internal strategic plan is looking at almost just about 40% of GDP. That's what we aspire to be by the end of 2024. That's the target we have. In terms of turnover ratio, we are looking at, the numbers correct me, we're looking at about 10% of market cap. This year, we are targeting 7.5%. And so progressively, we're looking at how we can proceed along. That's how we're looking at it.
All right. There's a really nice discussion going on, driven by Ramanyang and Dande in the comments section about the corporate bond market, which has been a bit challenged for a while. I'll try to find if there's some questions, but also I think Rama also agrees with Nderi's outlook on the pain to come that there are very many data points that are actually flashing red, and some of the data is coming from the agricultural side. So it looks pretty grim in terms of general outlook of the economy, and we know the economy ultimately will affect the stock market. Kevin seems to have more questions to ask. Kevin?
I wanted to respond, I think it was to George in terms of retail bonds, but again, to be fair, he addressed the questions to Jeff, and maybe Jeff forgot to mention on that. Maybe can speak to that, and then I can add something from a broker's or an investment bank's perspective. Jeff?
All right. Retail bonds, again, I think the challenge at the moment is to do with the first account opening process, which I think is being addressed now, possibly once certain information are done, that should be a bit more easier. But I think also the issue of the size of the trades. Normally, this market trades huge amounts, and at some point, anything's lower than some levels is considered like an odd lot. And I think what's going to help us, even as we look forward, is how can we get in market makers into this market who can then be able to provide two-way pricing opportunity for investors to come in and be able to aggregate these positions. I think that's what we're going to be looking at. We're trying to get market makers in most of our products, and that should be able to help. But I think this possibly is a good question for the brokers to address, because from our side, in terms of infrastructure, it is able to trade lots of more sizes. So that shouldn't be a impediment. Maybe Kevin can step in now.
Thanks, Jeff. And I do agree with you. I think the issue, George, with retail bonds from a trading perspective is not really to do with the stakeholders. NSE really doesn't come in here until the end point, which is the point of trade. And to Jeff's point again is when trading retail odds, they're almost really secluded, whether you're trading at 10 million or 5 million or 20 million. It's really an odd lot if you look at the ticket sizes that we trade in the bonds market. So one of the issues that has been is just sending the empties, the SWIFT codes. So if you look at a bank equity trading with quickly send a SWIFT code confirmation to sell, the others will send an intention to buy, what you call the MTs. That will be done simultaneously, maybe a day before or that on the trading day early in the morning. So really is compounded by the central bank, and that's where most of the issues come in. So we, as at the CDA or the representative of the client, has to come in and just send these codes to the central bank. If central bank by any chance try and reach the client and the client is unreachable, again, this process almost restarts again. And I understand your pain that it's a hell to trade corporate bonds. Then again, on the liquidity side, again, just to agree with Jeff or to second what Jeff has said, is I think it's about time the market is rich to have a market maker. Because most of the times you'll find, especially if you look at clients who bought, I think it was a 30-year bond, the SDP, I'm not too sure on the tenure, and they were really caught out. And you almost have to go back to the CBK to sell it, who will almost penalize you 7.5% just to go back to them. So I think, yes, one, it's time the market is ripe for a market maker. Two, I think the CBK as the main stakeholder of bond trading really needs to simplify the process from account opening. It needs to be digital. We're at a place now we need to open it digitally. Right now, you can't open a CDS until you take your mandate card to central bank so that they can verify it by looking at you physically. It really beats the purpose. So, and of course, also in terms of SWIFTs and how they engage the client, I think all this process, if only CBK digitizes their processes, then I think also the retail segment of trading would also be simplified. Eric.
All right, thank you.
Let me say something about that. If you look at the bond price list for like even the last week, most of the trades are less than 50 million. So there's an uptick of people who are doing smaller lot sizes. So 1 million, 2 million, 10 mic. The issue is the turnaround time, right? So if I'm a small trader and I don't have a custodial account, it will take me ages to fill the green. Yes, I know it's a CBK issue, but then can the NSE come in and tell them that this can be made easier? We need a way to make this easier, because I can give you an example. I have a client who's maybe in Kisumu. I need to get the green forms to them. They fill them. They probably send them with the shuttle and all that. So can we get an easier way to avail the bonds so that they can be tradable? Because retail trading has really picked up.
Yeah, and a lot of work is going on behind the scenes about issues of how to address retail and make retail trading a lot easier. Again, this is a matter that we're working closely with CBK, and we should be able to be giving out some progress at some point. But the whole essence of enhancing the CBK platform is to provide very, very easy access for investors to all open accounts and to trade. That's really the plan.
We set up a small WhatsApp group and raised a couple of points which I wanted to highlight and maybe get a response from you about them. So one of them is about removing the odd lot purchase requirements. It feels like every time you have to purchase them in terms of odd lots. I'm wondering, is there a plan to get rid of these odd lots? Because it restricts in terms of you have some free money, you have to wait until you have the odd lots to be able to trade at the end of the day. Is there a plan to remove some of these odd lots restrictions for the retail investor?
I think that the board has a role, and you don't want to preclude anybody from trading. What I'm even seeing now, innovations coming through, I'm seeing discussions around fractional trading and opportunities for investors to buy small lots from such players. And that's going to be the new revolution, in my view, around how to then rethink the odd lot board once you start seeing that happen. So yeah, let me just say this is good feedback. Again, you can look at it. At this point, I can't give you any exact answer to it.
Yeah, but we would want a bit more concrete responses to some of the questions, especially like the odd lots issue. Is there a consideration of looking at it in terms of it's being restrictive in terms of someone wanting to buy shares which are not in the odd lots? Is there a plan in the near term to at least address this? And do you see it actually as a problem?
Okay. A lot of these needs are assessed on as regularly as we can, looking at how we can improve the market infrastructure and really where the pain points are. And as I said, we do review all these at any point in time. And this is, again, as you said, if you can share that feedback, I'll be able to come back to you with some direction on it.
I'm really hoping that this, as you say, you're coming back, you'll really come back.
The NSE is very responsive. I don't know where the doubt is coming from. We're a very responsive organization, so get back to you.
Especially, I think one of the two easy ones is one is the earnings calendar. I want to see the NSE itself issue an earnings calendar, at least from this financial year. I'm really looking forward to that. One of the other things that you're also seeing a lot, which is present in the market, and which was one of the issues that you raised, by the way, I should say, top issue that was raised in the small group was about slashing transaction costs, actually slashing them, not just reducing here and there, like the way you said, like you reduce one way or not the other way. So I think that was very important to some of the retail investors that you've talked to. So secondly was about removing the odd lots requirement in purchases. So to facilitate people making, and like if I have some money left, I should just be able to buy the number of shares that I can be able to. I don't have to wait to assemble 100 shares. You can actually buy 1 or 2 shares at the end of the day. So I think that's very important. The third thing that they talked about is that it require and encourage companies to have an earnings calendar and hold earnings call conferences to engage with analysts and shareholders. There's several companies. If you go below like the top 10 or top 15, they don't have an earnings calendar, most of them. Secondly, they don't hold conferences or at least places where people can ask questions. I see a couple of them trying, but many companies at the NSE don't hold an earnings call, so they only release results in the paper. So if you really want to have an informed investor base, beyond just them knowing about the 5 top companies, we should have as many of these companies as possible reporting. So, and a very easy suggestion of that would be hold one day. Perhaps the NSE itself holds a single day where they invite some of these companies who have never talked to investors to come and talk to investors. Just maybe 1 hour each, some of these companies a day, afternoon, morning, can be helpful with some of these companies to facilitate them to have an earnings calendar. Do you hold earnings calls conferences for analysts and investors yourself, NSE?
We do that, Eric. We do that very regularly. We even do market briefs. We've got a platform called the Barometer, which we made some announcements recently.
Okay. I wasn't aware of that, so thank you. Perhaps more points that the investors raised, which I will also assemble and send to your team. So stricter enforcement of regulations and penalties, including on directors and officers of companies failing to comply with the regulations. This comes back to the issue of several of these companies are releasing earnings warnings, the profit warnings, as they call them, which are really not profit warnings, because some of them don't even make a profit. Some of these warnings are coming in very late in the earnings calendar. So like if you're releasing a profit warning for something that you're going to release next week, it doesn't really make practical sense. You should have been aware of this a bit earlier and then to be able to release. So we need to see a bit more stricter enforcement of some of these regulations. And especially some of these companies which are also reporting very late, we need to hear a bit more action from some of them. There was an issue of, and I haven't heard much of it. Kenyan was supposed to have issued a profit warning. They did not last year. There was a little bit of back and forth in the newspapers with the regulators and all. I know like maybe it's not within the jurisdiction of the NSE, but perhaps since you're very much in touch with the CMA, if there is a violation, the NSE needs to raise it and then to be able to punish some of these companies. I know they will object to that, but I think some of the directors need to be held to account in terms of this. And finally, I think I'll allow you to respond to the question. So finally, with the issue of reinstatement of tax benefits for listing that were available until 2020, so they were removed. It will be very important for some of these companies, especially to encourage listing, to bring up some of the benefits that we had before so that we can be able to encourage listing. So, and perhaps also, I think you've been trying to encourage government to list some of their entities. The challenge we have, especially in the market presently with some of the companies that the government is a major shareholder in, is mostly that they're not, in my estimation, sometimes really forthcoming with information to investors. So I think that's something that needs to be worked on. They're not doing well as companies, say Kenya Re and its own. I think that's an example of a company that's not doing very well, even though it's government owned. So there's a bit of risk there in the market. So those are the 5 points that investors, at least a small group that we are in, have consistently and raised issues about. To recap, the costs, removing odd lots requirements, requiring earnings calendars, strict enforcement of regulations and penalties, and finally, reinstatement of tax benefits for listing. Would you want to comment on any of those?
I think that's good feedback. We've had discussions around those. The only one I think which we have not based on is on the incentives. So we've got the public open listing regulations out for exposure. So this is the time we can actually make comments to see how else we can incentivize the listing framework and be able then to address any or to add or to put in place any areas that we feel will provide high incentives. We regularly, as part of our feedback to the budget process and also to the finance bill post-budget reading, always look at the incentive structures for the market. We feel that it's detrimental. We've been able to have those repealed, examples like capital gains tax, the revenue tax, and a number of others. And we've also been able to bring in certain tax incentives, for instance, infrastructure bonds raised on the market, for the REITs market, etc. So we continuously look at that and definitely be finding ways of improving that further. I think all the other points you've raised are good. Let us get them formally, be able to take actions on those.
All right, I'll draft a letter, I think, on behalf of the investors on this. So I can see Kevin has a point to raise. Kevin.
Thanks, Eric. Mine is just brief in line with the guidance circular calendar for the equity space. I think with Jeff, with a seat at the table, I think it would also be helpful that if you're going to benchmark ourselves against some of these markets that we want to emulate, and Jeff mentioned, I think, Bangladesh, and I mentioned Pakistan, and there's also Vietnam and some of these Asian countries. In terms of the debt market, I don't know what, Jeff, you'd add to this in terms of we also need sort of a guidance, a circular for the year. We do know right now that if we are talking about IFPs, the government traditionally has been issuing 2 IFPs, one earlier on in the year and one that brokers call a Christmas gift, though we've seen in a couple of years that they've also issued 3. So from a bonds investor or a bonds trade, we don't have visibility as to which papers the government will be floating for the year. I think some other developed markets have these. I think maybe, Jeff, you could help us with a seat the high at the table, not really lobby, but just also with CBK as and Treasury as stakeholders also, is just to have a guidance, as I don't know how viable this on maybe in 2023 on what 10 years, or we already know our deficits and probably how much Treasury would be looking to tap into the market. Just maybe to get guidance on that as well. How viable is that, Jeff?
Kevin, we are aware about the issues calendar. I think I will just engage further with the team there and just find out what the program government side is. It's a conversation that they have to have with national government issues calendar. But it's a good point. I know sessions are being held. Some that will still reinforce.
Thanks, Jeff.
All right. I see Felix here. Felix from Trading Room. Karibu, Felix.
Thanks a lot, Eric. It's a very interesting conversation that you have today, and looks like Jeff has been here to answer a lot of the heat that has been coming in through. Probably, Jeff, just to mention, I know a lot of times brokers have complained for less support that comes from the NSE. The trading members always have not really complained, but they air out their issues. Let me put it that way. There are a lot of incentives that brokers have even put up to look at an alternative. Speaking of the bond market, what this has really been, a lot of brokers are trying to bring in issues like bond stripping. As guys talk about going digital on the entire bonds trading bit, the volumes are a bit rising, but then also there's a challenge for brokers setting up this because of the regulator. I don't know if the NSE is always in support of this. What's your view of that? I think it would be awesome if guys could be able to trade the small lots. I know you've spoken about it, and one of the speakers had also mentioned that we've seen a rise of activity on the retail market. But let's also talk about this. I know we see the trades that come in, but 50 million is not an amount that everybody is going to find when you talk about the odd lots on the bond market. How about the NSE and even brokers? I mean, a few brokers have tried this. I think that the challenge still jumps in on the custody of the bond. And that's why a lot of going that way for bond stripping. Is there a way the NSE can really jump into this?
Did you want to take that?
Just give me a clarification. When you say bond stripping,
Okay, it's sort of like a money market for bonds where brokers would jump in, they would buy the bond, and then they sell it to the retail market at a smaller cost, probably like a smaller lot. So let's say if I wanted to buy my IFB for the minimum requirement, and I can buy it, and then immediately I want to sell, the broker would actually buy it from me. So it's always like the broker would price them at a little bit of a juicier value, or something that's a little bit lower than what is offered at the rate that the bond was offered at. An example is if an AFB is going for 11%, the broker would offer it at 10%. So the broker would be making that little X percentage of the bond. So it's more of a liquidity on the bond market to increase the value. It's sort of like an Kiba. But in this case, the small lots and the small values, it's the broker who's making the money from it. I mean, it's something that even the NSE itself can actually provide, the same way that the derivative space is being traded at. The same system can actually still be used for the bonds stripping. There's a broker that wanted to propose this idea, but when I spoke to one of them, they actually mentioned that the KBA and CMA were not in for this. And also Central Bank brought in a lot of questions regarding the custody of this bit. So I'm just wondering why this has been a challenge. I mean, the activity, and I really appreciate guys saying that we're seeing bond values, the odd values really jumping in, about 50 million, 10 million trading. But that's not the value that we're going to get on the retail market for everyone. I mean, not everybody has 50 million, not everybody has 1 million. That's really what the entirety of the question involves. Thanks.
so ideally something similar to primary dealership, right?
Yeah, that's right.
I do a lot of retail trades, a lot. Like, that's my specialty. And it's very right. If you look at the price list today, there's IFB 24, which is 2021, 2019, the latest IFB. Either somebody bought it or sold it at 13.6, which is way off market. I agree with Felix. When it comes to retail trading, it's an unfair market because it boils down to what you're willing to sell it at. And I've had situations where somebody really needs the money and you tell them a figure, because you see, I still have to go to the market and tell someone I have this paper on offer. So I still have to get like a bid. And when I go to this person and tell them, this is what I have on offer, the price is way off market. So I agree with Felix. So how can we sort this out? Because when you look at some of the pricing, it's crazy off market.
Can I speak to that a bit, Eric?
Yes.
Okay, all right. I've also been doing, and I still do, a bit of retail trading on the bonds market. And for me, on that score, there really isn't any magic to it. Anytime you're buying or selling an asset, your ability to get as close as possible to the true price of the asset is really a numbers game. If you don't have quite a number of buyers and sellers trading, you'll always have volatility in asset prices, and you'll always have situations where the prices go off whack, as you said. And in that market right now, it's not unusual to see yields going spreads of 50, 100 basis points away from where the yield curve is. And this is where sometimes I look at with our history with nostalgia, with what guys like Murigo and Mbaru did for this market as brokers. I think they did quite a bit of investor education, especially between 2000 and 2005, 6, thereabouts. And we saw quite a takeoff equities trading. And obviously it was supported by some macro issues. Kibaki came in and the monetary policy was a little different and things that. However, that's been one of the missing issues. I think there is quite a bit of interest from the retail sector on bonds. It's just that they really don't know how to go about it. And one thing that I've learned in this business, in the financial services businesses, in fact, my first stint in financial services was insurance sales. And I was told that if financial services are sold, they're not bought. So it's up to us brokers to go out there and popularize this bonds story a lot more. We got to put in the work, because in any case, it's us who are making the money. And that's how we create a more vibrant retail bond trading market. And that's how we get better prices for our customers in the long run. That's how I would look at it. Thanks.
Can I say something about that? Do you know how I sign off my cover letters? Because you see, you have to have a cover letter if you're doing a retail bond trade. You say you need to sell it at the best prevailing market price. So 13.6 is way off where the implied yield is. It's really sad that for retail investors, they get really hit. And I agree with you. Yeah, it's market sentiment. Because you see, this person has 500K, a million. So I need to get a proper price where I'm buying this. But I find it's really unfair. So the best way would be to probably have a different market. I don't know how hard that is for retail traders. For the people who have 500,000, a million, 2 million, then you can't put them in the same pool as somebody who does 300 million trade.
I think the dynamic will be the same, because so look at this scenario. So you have a different market altogether. You've got your infrastructure that you set up to support this trading and whatnot. And then you still go there and you find that in the market, only 2 or 3 buyers are willing to match you. And each one of them is giving you 100 bips, spread from where the yield curve is. Don't you think that will be the same problem? I think it's a numbers game. You need good demand at any one time when you're selling, so that you can get as close as possible the correct asset price. And for me, and of course, that's a liquidity issue. And it's the same for all asset markets, whether you're talking about real estate, whether you're talking about bond trading, shares trading. It's really a numbers game. If there are more guys willing to buy that bond, the more likely you are to get a fair price. We have this terminology, we call it a buyer's market, a seller's market. When it's a buyer's market, it's because there are few buyers in the market. When it's a seller's market, it's because there are so many buyers in the market. So if we want to make it a liquid market, we just need to push a lot more retail to these products, so that they can know that they exist and they'll be able to participate. And by the way, us as ABC Capital, we've been able to do that. We're able to, if you're selling 1 million, 2 million shillings, we've always got some retailers on the other side who are always looking to get into bonds. We sell our secondary market deals much stronger than we do our primary market deals. So that way we are able to get good deals, good exits for our clients.
We'll definitely have a separate discussion soon, especially on the bonds market. I see a very hot discussion going on just below our pinned tweet on this and more. So I think we'll definitely have a follow-up on this. So Nderi, George, you're welcome to that next space also. I appreciate the fact that Jeff took time to come to spaces and to listen in. We appreciate it in the sense of we also extended invites to the likes of CMA and CDSC, and they were unable to make. So it's very welcome that you're coming. But also, since you sit on these boards, we encourage you to encourage them to also come to spaces in the future. There's a lot of people who are asking if they could come also and talk to people. The investors just want to air they want to see that some of these organizations are also responsive to some of the concerns that they raise, even that they're thinking about them, that they hear them. So you can also have a better market. This NSE is playing a key role in terms of coming and listening to us, but also we would want the others also to come at the end of the day. Now, over to you. Did you have something to say?
Yeah, thank you very much. And hello, everybody. I'm Kevin Gogo. I will surprise many people here by saying that I'm not Kenyan, even if I'm very active. But the point is that I've started investing in Kenya, and particularly in NSE, since the 90s. I'm very glad that Geoffrey is there, because I just want to explain that from the 90s till now, I think it's clear there is something that is not working on the market. Of course, you have big and you have there, and you have also a rising market, rising trading, all this kind of thing. But there is intrinsically something that has changed. And what has changed, in my view, is that the markets, and above all, also the NSE, the market and the sovereign, the state has become unpredictable. I will just explain to you one thing. I don't think that in the years 2000s, under the Kibaki regime, I don't think it will have come to the government, this idea of imposing a capital gain tax. Never, I'm quite sure. And this is what I think the NSE has to think about that. There is something that has shifted. Politicians are no longer afraid of intervening in the market, capital gain tax, and also price control. So I think there is a dynamic that goes really beyond the trading floor. And I had the impression that 20 years back, even the NSE was able to influence the decision-making process beyond the trading floor. And I think for a frontier market like Kenya, it's very, very important. And as Mokaya put it so rightly, it's not normal in 2022 that investors are struggling just to know when the firms are releasing their results. I think that is mind-boggling. Everything is digital. And even you see some banks who know every day what they are earning coming in the last week of the earning period to release. So I think there is something the NSE must be proactive. When I started investing in Kenya, the shilling was at 62. Just look at where it is now. It means that these policies are influencing the dynamic of the market. And the last point also, I would say, look at also, you have many listed companies who are behaving more as, I would say, a ministerial department than a listed firm. The role of the NEC is not only to table the fees, but to protect the interests of the shareholders. Geoffrey, if we remove ourselves from the CDS account, there is no CDS anymore. There is no stock market. There is no NSE. I think it's very important for the NSE to intervene and to be proactive. It's not normal that decision can be made in listed firms that impacts and endanger the interests of shareholders. I will not give a list of the decision, but for instance, look at KPLC, even the PPAs which are signed, as long as it is the structure of the contract on the energy in the energy sector, I don't think that KPLC will ever come back to a profit. And it's also very important, irrespective of what kind of firm the NSE is dealing with, if they are violating the rule of reporting, NSE must punish them, clear. And if those companies are not able to register profit over 3 or 4 years, it must be also delisted. So I think we need to bring back the predictability, a kind of predictability in the market, because investors and shareholders, they need incentive. For instance, there was the tax withholding on foreigners, for instance. I understand that the decision was taken during the COVID. After the COVID, I think the NSA must approach the Treasury and you remove that. Foreign investors, it's not that because, yes, but they are the backbone of the Kenyan market and the frontiers market and emerging market. So this was really my contribution. We need a very proactive NSE at the policy front and also, I would say, at the economic front. That is my contribution. Thank you.
Thanks. We should be winding up the spaces. It's been 2 hours, but I think he raises very important points. To have robust capital markets, the players in the industry need to be held at least to very high accounts. So like if they're not reporting on time, there should be some level of punishment or at least some level of engagement with them to see what exactly can be done in terms of them reporting on time. So if there's, we need to have a market where most of the companies are in the market, actually good companies, so that they can see that there are benefits to actually being on the capital market. So I think that's very important. So I think I want to go to the closing stages. I know Tim has to leave, so I'll give Tim first to give his closing comments. So Tim?
Yes, thanks very much, Eric. I just wanted to end on a positive note and say it's great that so many people show up on a Friday night to discuss these issues, and appreciation also to the NSE CEO for showing up. We really do appreciate it, and let's continue the conversation. I'll sign off there.
All right. Thank you, Tim. Now it's time for all of you to give some closing remarks, and Jeff can wind up for us. So I'll start with the speakers who just came in. Quick ones from George, Ruben, and he. Quick ones, less than 30 seconds. Tell us what your closing thoughts.
Well, mine is yes, we should have a different spaces for bonds, but true, there's a lot of potential. So we need to look into that and see how we can harness it. Thanks.
Ruben?
Mine is just to say thanks to you, Eric, and the Mwango team for making this possible. And again, Jeff, thanks for always making time to come and discuss these pertinent issues. And looking forward to catching up on how to further enhance the green markets in Kenya. Thank you.
Then we have, I think, Hugh and then Felix.
Thank you very much. Thank you all. I'm very glad that Geoffrey is with us here, and I really appreciate that he's interacting with investors and shareholders. I just want to insist on the fact that in frontiers market like us, everything the sovereign does is very important. And I think it is a little bit provocative, but I will advise the NSA to be embedded with that and what they are about to do that will severely impact the market. And as Rama said in his tweet, I think the deficit is at 8%. How could the economy manage something like that? So I really think that the NSA will be one powerful if it will be very, I would say, will reward investors if they look beyond the trading floor and see really the environment. And the current environment in Kenya is not conducive for business. Simply, something has to change. Thank you very much.
Thanks.
Mine just to say thanks a lot to Eric and the team at Mwango Capital for this space. And thanks, Jeff. Getting you to make time for this was really amazing. Probably you could spread the gospel to other stakeholders in the capital market space. It would be awesome too, if they'd be easily reachable. And then just not about talking, it's also about implementing some of these things that we say here so that we don't have an entire 2 hours on Friday go out to space. Hopefully, we've seen a bit of guys calling in and like the issue for CDSC, the rates had to be halted because it really didn't go through. I mean, investment banking has always been a bit of growing wealth, not just for the brokers and the exchange and also other capital markets stakeholders, but also for the retail market as well. Thank you.
All right. Now to our core speakers here. Derek, what are your closing thoughts today?
Thanks. First of all, I'd like to thank everybody who made the time to be here, especially for and everybody else. The direction you're taking, I think that's a very, very important issue that we essentially closed our eyes to. Maybe it's because of the nature of the entity we will be taking on if we spoke a little louder, but I think what needs to be said must be said. I also want to encourage guys to look at the new public listing regs that are coming out. I think they'll form a very important part of discussions going forward. Thanks all.
Kevin?
Thanks, Eric. And again, I'll reiterate what everybody has said in terms of it's been an engaging Twitter space. I loved it. And just there are no enemies on these platforms. We all have a symbiotic relationship. Jeff is there because I'm here. I'm here because he's there. We are all and of each other. And I'd end by quoting something I picked from a good friend, Edwin Dande, that talking is a solemn duty. And the more we have these engagements, the more we expect to see our capital markets just take a flight. Thanks, Jeff. I think we are neighbors, 100 meters from each other. We can always take some of these engagements and just keeping you in check, and you're keeping us in check right from our offices. Thanks a lot, Eric.
All right, Kevin, thanks so much also. So, Jeff, as you can hear, people are appreciative that you took 2.5 hours of your time on a Friday night to be here discussing capital markets. So we do really appreciate it. It may sometimes feel like people are antagonistic, but mostly it's because we have the best interests of the capital markets at heart. At the core, people want to engage. They want to talk to their regulators. They want to talk to the capital market leads and to be able to see that their voices are being heard. And that was the core essence of this. So it was a sweet surprise to see you pop in. I sent you a text, and I also sent a text to your team, and I appreciate that was enough. I didn't actually do a lot of follow-up, so I was actually very sweetly surprised that you turned up. So very, very encouraging. And we hope for this and more discussions. There is a good friend of mine who sent me a text and said that we can make this quarterly. I think it can be the Jeff State of the Union address. So if you want, we can make it quarterly, and you can come and report for us perhaps what we've done, accomplished from last time, and what you want us to accomplish in the next quarter. Like the earnings calendar can be a very easy one. I can help your team to come up with that's possible. Jeff, now closing thoughts from you, even as we wind up the spaces.
Thank you very much. And I think first of all to say that I'm very happy to have been part of this. I've attended your first spaces discussion and I really liked it. So I wouldn't have missed this one. I appreciate the thoughts, by the way. This was a very good discourse, and I do understand that when you put on the spot sometimes it's possibly the tone, but the spirit was good. And thank you very much for your feedback. And ideally, I like your topic because it's about, and we are all in this together. We want to get the market up there. We want to get it active, and very strong points. I like the discussions from Harvey. Sorry, I didn't have time to respond to that, but I think those points are well taken. And even as we engage with national government, go to actually make the distinction between where does their role end and where does collapse and some challenges we face. But that's a good point, and we're going to take those points. So, all I want to say, thank you, Eric. I really appreciate it today, and thanks for your compliments. I can assure you that my team members are here. They've taken some of those notes. And Eric, if you could share those thoughts that you picked on the online, please give it to us. My team, I have a new chief business officer. She's from Peter Mwema, who's also very active in this kind of platforms. And I believe we have more engagement. And yes, invite us. We'll be happy to have this quarterly so that we can see whether we're making progress and whether we're facing challenges. And I'll also talk to my other colleagues to tell them to join such discussions. So thank you very much. And thanks for energetic discussions. And I look forward to meeting you guys next time. Thank you very much.
And about the quarterly meeting, you can make it quarterly. I get your word from you.
Fine. That's fine.
Thank you so much. I think from your team, I've also been engaging with the Rungu and also with Bita. Very encouraging discussions along the way with them. So thank you so much for those two and also for you for coming. And there's a really nice discussion that is going on. I would urge all of you to follow up just below the pinned tweets. And there's Ramanyang, who's actively engaging in discussions around corporate bonds and saying a lot of thank you also. So I can see also Ruben is very active there in terms of responding to questions, and Edwin Dande also. So I should be very, very grateful that they joined too. So thank you for the speakers, for the audience. This has been a huge audience on a Friday evening. Around 200 plus joined in at one point. So thank you for coming to Spaces, first of all, and thank you for engaging. So we are open to receiving all the suggestions that you have. If you still have points that you want to raise, just DM us, or you can drop us an email at hello@mwangocapital.com. We'll compile all those thoughts and be able to now forward them to the NSE to be acted upon. I had invited the CDSC chair. He wasn't able to join us because of some previous engagements, but hopefully soon we'll be able to host them also. We'll definitely have more spaces on the markets. Thank you so much.